Imagine you're standing outside a casino. The neon lights are blinding. There's a line around the block. People are dressed up, excited, whispering about how this is the one, the night everyone walks out rich. You've heard the name of this casino your whole life. You trust it, so you walk in. What you don't know, and what nobody at the door is going to tell you, is that the house built a trap door directly beneath the most popular table. And the second you sit down and slide your chips forward, it opens. That's not a metaphor I'm using loosely. That is, almost precisely, what is unfolding with the incoming wave of historic IPOs, SpaceX, OpenAI, Anthropic, companies whose names alone carry the kind of gravitational pull that makes ordinary people do financially irrational things. And I'm not here to tell you these are bad companies. Some of them may end up being the defining businesses of the next 50 years. I'm here to tell you that being great and being a great investment at IPO are two entirely different things. And the gap between those two ideas has destroyed more retirement accounts than almost any other trap in modern finance. Let's talk about why. There's a psychological trick being played on millions of people right now, and it's brilliantly subtle. When a company like SpaceX announces it's going public, the narrative in the media goes something like, "This is your chance to get in on the ground floor." But here's what nobody says out loud. The ground floor was 10 years ago. The ground floor was when venture capital firms, sovereign wealth funds, and private equity players wrote checks when SpaceX was still blowing up rockets on a launch pad in the middle of the Texas desert. Those investors got in at fractions of a penny on the dollar compared to where this company will be priced when it hits public markets. By the time you and I can buy a share on an exchange, we're not on the ground floor. We're on maybe the 40th floor of a building that insiders built from the basement up. Think about it this way. Imagine a vintage bottle of wine. A collector finds it in 1985 for $12 at an estate sale. Over the decades, it appreciates quietly, hidden from the public. Then one day, it goes to auction. The auction house creates a spectacle. Cameras, press, buzz, and the bottle sells for $18,000. Who made money? The collector who held it for 40 years? Not the person who got caught up in the auction room excitement and bid $18,000 on impulse because everyone else was bidding too. They paid retail for something that was only ever priced for wholesale buyers. That's the IPO market in a nutshell. The vintage was drunk long before you got to the table. Now here's where things get genuinely alarming. And I say that not to be dramatic, but because most retail investors have absolutely no idea this is happening. The rules governing how companies go public have quietly been rewritten for this incoming wave of IPOs. And the changes benefit exactly one group of people: the people who were already in before you. Historically, when a company goes public, early investors, the people who got in at $1 when you're buying at $40, are legally required to hold their shares for a defined lockup period, usually 6 months, sometimes a year. The purpose of this rule was simple. Don't let the people who bought cheap flood the market with selling pressure the moment ordinary investors pile in. It's the financial equivalent of a dam. The dam holds back the water long enough for the lake to fill. You get to swim. Then, once the dust settles, the dam is opened gradually. But with SpaceX's IPO structure, that dam is essentially made of paper. Early investors can begin offloading shares within days of the IPO, not months. And notably, the more retail buying pressure drives the price up, the more early investors are permitted to sell. It's a release valve that activates precisely when retail enthusiasm is at its peak. Read that again, slowly. The hotter the stock gets, the more insiders can dump. This isn't a conspiracy theory, it's written into the prospectus. Here's the second rule change. And this one affects people who have never bought a single stock in their life and still won't be safe from it. Normally, for a company to be included in a major index like the S&P 500 or the NASDAQ 100, it has to earn that spot. There are profitability requirements, seasoning periods, float requirements, meaning a meaningful percentage of the company's actual shares have to be publicly available. These rules exist so that index funds, which your 401k, your pension, your teacher's retirement account are likely invested in, don't get artificially overexposed to a single, volatile, newly public company. Those rules are being waived, or bent, or multiplied into something that doesn't resemble their original intent. SpaceX is expected to receive fast-track entry into major indexes within the first 2 to 3 weeks of trading. That means within days of the IPO, every passive investor in America, people who have never heard of Starlink, who don't know what a Falcon 9 is, who are just contributing to their company's 401k, will automatically have their money diverted into SpaceX shares, not because they chose to, because the index said so. And it gets stranger. Because SpaceX is only releasing a small slice of its total shares to the public, maybe 3% to the company's total equity, the index is applying what's being called a float multiplier. Essentially, the index pretends there are more shares available than there actually are, and allocates buying accordingly. The effect? Artificial, structurally mandated demand being injected into a stock with extremely limited supply. Supply and demand. You don't need an economics degree to know what happens when demand gets pumped and supply stays constrained. Price goes up, artificially, temporarily. Let me give you 3 case studies. In 2019, Lyft went public amid enormous fanfare. It was the future of transportation, the sharing economy. It was going to take on the entire auto industry. First day trading was electric. Retail poured in. The stock opened at $87. Within a year, it had lost 2/3 of its value. Within 2 years, it was trading below $20. The company is real. The service is used by millions. But the price at IPO had almost nothing to do with the company's fundamental value. It had everything to do with the narrative, the hype machine, and the exit needs of early investors. Snowflake IPO'd in 2020 and became the largest software IPO in history at the time. Warren Buffett backed it. Salesforce backed it. Institutional money piled in. Retail, seeing the validation from the smartest money in the room, followed. The stock opened at $245. It hit $400 within weeks. It then proceeded to fall more than 80% over the next 2 years. One of the most punishing declines a high-profile tech IPO has ever experienced, while the company continued to grow revenue at impressive rates. The business was fine. The entry price was the problem. ARM Holdings IPO'd in September 2023 with enormous institutional backing. It was positioned as the backbone of the AI chip revolution. It IPO'd at $51, surged past $60 in days. Then it fell. Then it recovered, spectacularly, as the AI wave lifted it. Some people made extraordinary returns, but the people who bought at the peak of that initial surge and panicked when it dropped 30%, they locked in losses on a company that eventually proved the bulls right. Timing, not company quality, determined who made money and who didn't. Let me be uncomfortable with you for a moment, because I think the financial media is not being uncomfortable enough. When a company that has not yet reached profitability, and some of these AI companies are burning cash at breathtaking rates, engineers an IPO with unprecedented rule changes, fast-track index inclusion, an early lockup dismantlement, and a float multiplier that artificially inflates index demand, you have to ask, who is this designed to serve? Is it designed to give retail investors a fair shot at owning a piece of the future? Or is it designed to create the most efficient, structurally mandated exit possible for the people who have been waiting years for their payday? I'll let you answer that. What I'll add is this. I'm not saying SpaceX or OpenAI or Anthropic are fraudulent companies. I genuinely believe some of them represent the most important technological development in human history. But a great company and a great investment are not the same thing at the moment of IPO. They can diverge wildly, and historically they do. The Roman Colosseum was an architectural marvel. But if you bought a ticket to the opening day, you were in the stands watching lions, not building the Colosseum. Here's what nobody on financial Twitter wants to admit. The professionals are not scrambling to buy IPOs. They're watching. They're modeling. They're waiting. Institutional investors with fiduciary duties, people whose job it is to protect someone else's money, almost universally know that the best entry price for an IPO is rarely the IPO price itself. Studies going back decades show that, on average, IPO stocks underperform the broader market in their first year of trading. Not always, not everyone, but on average. Why? Because the IPO price is set by the company and its investment bankers. Their incentive is to maximize the money raised. Your incentive is to maximize returns. Those two incentives are structurally, mathematically opposed. So what do professional investors do? They wait for the post-IPO volatility to settle. They wait for insider lockups to expire so the selling pressure is gone. They wait for the company to release actual public earnings, not projections, not narratives, not decks, actual numbers. And then they make a disciplined decision based on value, not hype. We are living in a moment where an extraordinary number of unicorn companies, private startups valued at over $1 billion, are all racing toward the public markets simultaneously. When you see a clustering of IPOs like this, it's usually because the people closest to these businesses, the people who know their financials, their burn rates, their real timelines to profitability, have decided that right now is the best time to get liquid. In behavioral finance, there's a concept called information asymmetry. It simply means one party in a transaction knows more than the other. In IPOs, the information asymmetry is almost comically tilted. The company's leadership, their investors, their bankers, they know everything. You know the pitch deck. When smart, informed, well-connected people are all simultaneously trying to convert their private stakes into public cash, it's worth pausing and asking, what do they know that the excitement in the room is covering up? History shows that peak IPO cycles, 1999, 2000, 2007, 2021, were followed by market-wide recessions. Not because the IPOs caused the recessions, but because both things were symptoms of the same underlying condition. late cycle exuberance, where capital is abundant, valuations are stretched, and everyone wants to get paid before the tide turns. This may not be that moment, but it rhymes. If you believe in these companies long term, the IPO window is almost certainly not your best entry point. Patient capital wins. The investors who made generational wealth from Amazon didn't buy it at its IPO. They bought it after the dot-com crash took it from $100 down to $5. That's when real conviction gets tested and real returns get made. If you're tempted by the hype, ask yourself one question. Am I buying this because I believe in the company's fundamentals? Or am I buying it because I'm afraid of missing out? Fear of missing out is the most expensive emotion in investing. It has destroyed more wealth than any market crash. If you already hold index funds, understand that you will passively own these companies whether you want to or not. That's not necessarily bad. It just means you should be aware and perhaps recalibrate your overall exposure so you understand what your portfolio actually contains. The greatest investors in history, Buffett, Munger, Lynch, shared one thing in common that almost nobody who watches financial news has internalized. They were almost pathologically uninterested in new, exciting, hyped things. They were interested in value. They were interested in boring. They were interested in businesses that cash flowed predictably, quarter after quarter, while everybody else was distracted by the shiny thing. The shiny thing is coming. It's called SpaceX and OpenAI and Anthropic and whatever comes after them, and it will be genuinely spectacular to watch. Just make sure you're watching from a safe distance and not from the seat directly above the trapdoor. Thanks for sticking with me to the end. If this helped you think more clearly about what's coming, share it with someone who needs to hear it before the hype machine hits full volume. Stay sharp.